Thank you for joining us in this evening's session. As I say, you're welcome to use the chat at any point. You're welcome to keep your microphones off until we allow the Q&A. And with us this evening, we have Darren Deeplal. He is a chartered accountant, meaning he spent many, many years learning maths so that we don't have to. And we are very excited to host him this evening and learn from him about how we can be a bit smarter with our money. And remember, this is not us telling you what to do. This is simply giving you advice and using maths, as much as we hate it, maths to our advantage so that we end up in a really good financial position when we want to be. So Darren, over to you. Have a wonderful presentation. Thank you for joining us this evening. And we look forward to it.
Yeah, thanks very much, Amy. It's great to be here. Welcome, everyone. I really hope today is impactful for you guys. At first, when I took on the assignment, I was kind of thinking, okay, I'm not going to have time because, I mean, if anyone knows what finance is, it's long hours, and I didn't know if I was going to be able to put in enough effort. But I mean, I took it on because I wanted to impart some knowledge on you guys and just inform you guys about money. I don't think it's so much about maths. It's more about, okay, I have this, what can I do with it to make it work for me and last as long as I want it to last? Yeah, who am I? As Amy has mentioned, I mean, I'm Darren. I am a qualified chartered accountant. Don't usually like telling that to people because there's perceptions about accountants being boring and what have you and whatnot. But I mean, it's completely the opposite, I think. Yeah, in my presentation today, as you'll see, I've tried to keep it very simple. I've gone back to very basic things, such as just understanding of money, because common knowledge from my experience is not common knowledge for everyone. So I've thought, let me start from the very basic beginnings and work my way through and get you guys through to budgeting and how tax can work for you and trying to pay the least amount of tax possible. So yeah, I'm just going to share my presentation. You guys can just tell me once it's up.
Sure, we can see.
Okay, perfect. Yeah, so the agenda for today, I hope it's not too much of information to take in, but I've tried to keep it very simple. The topics might be a little bit higher level, but I've tried to dumb it down a bit to make it understandable for everyone so that all of you can use tools and things that you might pick up from today. You might not pick up everything, or you might not be able to learn from every single topic, but my hope is that you just take at least one or two key points that I go through today to improve where you are in your life financially. So yeah, just doing a welcome. I think that's what we've now covered. Topic 2 would be understanding of money. 3, budgeting in real life. So this is just putting a budget together. I'm not too sure if any of you actually do that currently, but this is more just me showing you how to put a budget together, how to track against the budget, and how to use it to your benefit. And then I've got understanding your income and your pay slip. For a lot of you are earning income and have a pay slip, you might not understand every single aspect on a pay slip, like why does a company deduct UIF, and why does a company have to deduct SDL, and what is tax, and those sort of aspects I do get into in that topic. Thereafter, just managing debt wisely. I think all of us sort of pick up debt along the way as we live our life. It's hard not to. I mean, once you might have extreme circumstances where you have to put yourself in a situation where you have to take out a loan, or if it's studies that you're paying towards and you can't afford it up front, or you can't afford it at that moment, you might have to take out a student loan, and all of those things are debt. And there's also stuff like store credit cards and credit cards themselves, overdraft facilities, and those are the type of things that I want to get into there. And then I want to get into savings and investments. So this is more future looking, more for your retirement plan, I think. And you can start that at any point, and the earlier you start those savings and those investments, the better it is for you in the long run. And then finally, my last topic would be navigating personal income tax. And that, obviously, as you know, the more you earn, the more you pay towards the government and tax. And that topic, my final topic, is just showing you guys how to pay the least amount of tax possible, how to set up your income and your expenses to try and pay the least amount over to SARS and have the most amount for yourself and your personal spend. What I've done with all these topics, I've tried to lay it out in a manner that speaks to each other. So starting with the very beginning being budgeting, and then everything running off income, and then your expenses thereafter. And then finally, we'll get into a Q&A at the end, as Amy has mentioned. So yeah, without further ado, understanding money. So yeah, what is money? So basically, money is a medium of exchange, a store value, a unit of account. It's in simple terms, it's basically how what we use to buy things. It's how we track things. It's how we put value to stuff. We measure the worth of things. I mean, what is the price of this car? That's sort of adding value or measuring worth of an item. In South Africa, as you know, we use the South African rand. Universally, everyone knows the US dollar, and that's sort of every sort of foreign currency always compares to the US dollar when you're working internationally, because that's sort of the universal um, currency of exchange. Um, how money works. So basically, money flows through a formal economy and is managed by the Reserve Bank as well as SARS and all regulatory financial institutions in South Africa. You can earn money from various income streams. You pay tax on it if it's applicable, if you're earning within those brackets, and you spend it on goods, services, and investments. The government also uses taxes to fund public services and try and improve the country where they can. Obviously, another topic that you can get into, very debatable, but those are sort of the things that money does, how money flows in South Africa. And then income sources. So you don't have to earn a salary to have an income. There's various sources of income that people do have. There is your usual employment income. So that'll be through your salaries, your wages, bonuses earned. If you're a sales rep, you're earning commission, and those sort of employment income. There is business income as well. So business income would be if you have a private company listed under your name, if you're a sole proprietor, if you're a freelancer, if you have a side hustle, for example, if you're an entrepreneur, that's another form of income. There's investment income as well. So if you have a bit of savings put aside, you'll earn interest on that if it's saved in a bank, or if you've now invested it in sort of shares in companies, or have like capital gains tax. Those are sort of investment incomes. There's rental income. So rental income being income that you earn from renting a property that you might own. And then the last one being like side hustles. So side hustles has become a big thing nowadays. It's basically something people do on the side of their full-time 8 to 5 job. This could be anything from tutoring to affiliate marketing to having small items that you sell on the side. It's all different sort of things. These are known as side hustles, and these are all things that you have to declare as your income when you submitting your tax returns, etc. And then, so expenses. So where does your money go? So basically, so expenses are basically the cost of living, and your expenses are what you use to survive and thrive. So basically, your basic needs and optional wants that you spend towards. There's different categories that you can push your expenses into. So there's fixed expenses, variable expenses, discretionary expenses. So your fixed expenses, these are expenses that you experience on a monthly basis. It's those expenses that don't change. It's like your rent, your bond, a car installment, it's insurance, it's a cell phone contract. It's stuff that you know that happens monthly, that doesn't change or doesn't fluctuate month on month. And then your variable expenses, those are needs that happen every month, but are variable in the sense of like groceries, utilities, transport, these things that vary month on month, but happen every single month. And then your discretionary expenses, those are things that you don't necessarily have to spend on every month. This would be like entertainment expenses, shopping for clothing, eating out. Those sort of things are discretionary. It's at your own discretion, meaning you don't have to incur that expense in a month. And then there's obviously debt repayments for those of you who might have a bit of debt that you're repaying monthly. A tip that I can give you guys is to track your expenses monthly, and that'll help you understand your spending behavior. A very easy way to do this is to keep a track of all your expenses from your bank statements. It's as simple as that. I'm sure you're able to download your bank statements, or you can contact your bank to give you your bank statement, and then you can go through your bank statement and categorize your expenses, as we've spoken about previously, fixed, variable, discretionary, and debt repayments. And you'll actually be surprised at how much you spend on things that you didn't have to spend on. And by doing that month on month, you can actually improve the way you use your money. So if you're earning like 10,000 Rand a month and you're spending it on Uber or Uber Eats, for example, every single month, and you're spending 5,000 Rand, you wouldn't know that unless you actually go in. Like there's always that incremental spend that happens every single month. You might have a plan to spend 200 Rand on a t-shirt, and you go to the shop and it's 275, and you're like, oh no, it's fine, it's only 75 Rand more. But doing that every single time, and you realize like at the end of the month now you've spent an extra 1,000 Rand that you shouldn't have spent or that you didn't intend on spending. And by tracking your expenses, it helps you cut back on that excessive spend and actually use your money to your benefit. And then inflation, this is what I like to call the silent eroder because we don't realize it's happening. And if you're earning a salary and your salary is growing annually at a lower rate than inflation, um, you'll then have less spending power. So for example, a loaf of bread used to be like 10 Rand in 2013, and now it's upward of like 20 Rand, 18 Rand. Depending on a loaf of bread that you want, you could even spend 30 Rand on a loaf of bread nowadays. Petrol, for example, was 11 Rand a liter in 2015, and today you're looking at around just over 20 Rand, 22 Rand at times per liter. So, I mean, all of these incremental increases or inflationary increases in expenses, it all hurts your pocket. And if your salary is not growing at the same rate as inflation year on year, you're actually getting less in terms of your spending power and how much you're able to spend. Um, yeah, and then finally, the rising cost of living. Um, so yeah, in South Africa, the costs are rising quite sharply, and it doesn't just involve inflation around food and petrol, but also things like water and electricity is increasing annually, school fees increase annually, transport, medical aid, everything is increasing on an annual basis. So that's why understanding your personal cash flow is so important, and planning ahead for your future it can help you so significantly, and you don't understand until you do it, until you get into it, that you'll be able to maybe save a bit more, save towards your future in terms of your retirement, and have more just on hand to do things with. Um, so yeah, to recap, just money is a tool. It's not just cash, but a value and control. You need to know your income sources and track your spending, which is very important. And just remember, inflation means that you need to make your money work for you. You need to work smarter and not just harder. Um, so I hope that helps you understand a bit more about what money is and where it starts and how it flows in the economy. The next topic, as I mentioned previously, is budgeting. So this is something I wanted to touch on because budgeting is quite important, and I think the only time you realize how important it is once you start doing it. And it's such a simple and easy sort of thing that you can do. I mean, you know, month on month what your income is. Obviously, if you aren't in a salary job, you might have a company which is earning fluctuating income every month, but you can try and forecast income for the year ahead or the months ahead. And income drives everything else in your budget. Income allows you to spend what you can spend on certain things, allows you to plan for the future, and allows you to just use your money as best as you can. So, I mean, income drives everything, and that's why I've chosen to start with budgeting and then work my way through everything else as the topics go on. So, what is a budget? A budget is a financial plan. It helps you track income, control spending, and plan for future goals. Think of it like a tracker of your money or GPS of your money. It tells you where you are and how you want to get to where you want to be financially. Um, so yeah, key points I would say is to plan and manage your income and expenses. This helps avoid overspending and debt and enables goal-based saving. Um, and then your principles of budgeting. So principles of budgeting. So there's various principles that you can get into with budgeting, but some of the main ones and the ones that I like to speak about or to track is to track every single cent. Now you don't have to do this at every single cent, but it's really good to track where your money is going to the rand. If you plan on spending 5,000 Rand on rent a month, and you're not tracking that, and you actually end up spending 7,000 Rand on rent a month, for example, you're out of pocket by 2,000 Rand, but you wouldn't realize that unless you know or you're tracking it against your budget. A simple one is spend less than you earn, so you always have a bit more in your pocket and you're able to do a little bit more with your money. A big one that I like to do is plan for your regular expenses. So you always have these irregular running costs. You never know when they're going to come up. You might need a medical bill that needs to be paid because you now have gotten sick, and it happens at the spur of a moment. So you never know when some things are going to happen. So it's always good to try and save an emergency fund, as you would call it. And then another sort of principle is pay yourself first, meaning make sure you're always putting something towards your savings monthly if you can. Even if it's as small as 100 Rand a month, just put something towards your savings so that, in the long run, you've got either an emergency fund, you're earning interest on the savings, your money is growing with you. And if you're never wanting to touch it, or if you don't touch it, it'll grow. And eventually in the future, you'll have a lot more than what you started with. And you'll actually be surprised at how well you're able to save. And a big one is review and adjust regularly. So with this being said, so a budget, I mean, you can put a budget together at the beginning of a year, but getting into the tracking and reviewing of your actuals versus your budget is a big part of doing a budget. I think just doing a budget isn't going to help you in any way if you're not actually sitting down and looking at your actuals against your budget. You never know where you actually stand. Setting financial goals is one of the big parts of doing a budget. You need to understand sort of what your financial goals are for your future. So your goals, as many of you may know, you get short-term, medium-term, and long-term goals in terms of financial and how that looks financially. So short-term goals, you're looking at an emergency fund that you might want to save towards. You might want to buy the next sort of device that comes out in the market. You might like sneakers, so you want to buy the next big sneaker brand or big sneaker drop that happens. And these are short-term goals that you want to save towards. Medium term, these are things like paying for studies. Maybe you're getting married in the next few months and you want to save towards that, or the next few years and you want to save towards that. Those are sort of medium-term goals. And then long-term goals, these are more 5 years plus. So it'll be along the likes of retirement savings, investments, maybe one day home ownership even. But Joe, if I can just ask you guys, I mean, I didn't ask you guys at the beginning, but if you guys, the session isn't going to be super interactive, but if I can ask you guys, maybe take out a page and pen, and if you want to take down notes and stuff along the way, because there is a lot that I'm covering, and you might want to take notes to ask a bit of questions towards the end. But for now, if you do have a pen and page in front of you, maybe just write down a short-term goal, medium-term goal, and long-term goal financially for yourself. These can be aspirational. It can be things that, for long term, it can be things where you see yourself in the future in the next 5 to 10 years. But it's always good to have that plan, because then once you have that plan, you can build a budget and save towards that plan. And then there's different sort of budgeting models that you get. This is more, I think, content heavy, but just so that you guys know, so you do get zero-based budgeting, you get the 50-30-20 rule, and you get category budgeting. So zero-based budgeting, in simple terms, means using every Rand that you bring in. So if you're earning a salary of like 10,000 Rand, you're using it to the cent. So you're basically putting that into your budget at 10,000 Rand income. You're spending 2,000 Rand on rent, you're spending 2,000 Rand on studies, you're spending 2,000 Rand on electricity, water, transport, and so on. And you also using your balance that you left over with, and you're putting it towards savings. And in that way, you're starting the month with zero, you're ending the month with zero, because your money is all being used. Now, the 50-30-20 rule is actually, it's a nice starting point for those of you who have never budgeted before. So what it basically is spending 50% on your income on your needs, 30% of your income on your wants, and 20% of your income on your savings and your debt. If you try and keep that ratio going for you, so if you earn 10,000 Rand a month again, 5,000 Rand of that needs to go towards your needs. Try and keep it to that 5,000 Rand or that 50%. 3,000 Rand or 30% of that needs to go towards your wants. Because I believe, like, as you're working, it's good to pay yourself. It's good to it's good to enjoy your money as well. You can't just or push it all into the bank and be living miserably, I think, because you're working quite hard to earn that money. So you should enjoy it as well. And then 20% or 2,000 Rand should go towards savings and debt repayment. So savings towards future sort of goals, as I've mentioned before, having goals is very important because you'll know how much to save towards them. And then there's debt repayments. It could be student loans that you're paying off, but make sure like you're trying to keep that as a rule of 50, 30, 20. It's very good to keep that rule because it's a great starting point for anyone who hasn't put a budget together. And then the category budgeting, that's just sort of categorizing your expenses and limiting your spend on each category. So as mentioned previously, if you're spending 5,000 Rand on rent, that's your limit. Do not go above that. If you do, then or if you have 3,000 Rand towards once being an entertainment and you go out this weekend and you spend 3,000 Rand, you know for that month you cannot spend anymore and you have to be strict with yourself so that you don't overspend every single month. Um, there's various tools that you can use when it comes to budgeting, but I think the easiest tool that I don't know if any of you, I don't know if all of you have access to, but Microsoft Excel is the easiest tool I think to use when it comes to budgeting. I mean, you can get as simple as using a pen and a page and putting everything down and making it very simple. Um, but from my experience, just having access to like Microsoft Excel or Google Sheets or some banking apps even have a budgeting tool built into it. You just have to sort of figure out how to navigate and get to it. But all it basically is, and I'll show you in the example that I have, it'll basically be an income, your expenses, your savings, and what you're left over with at the end of the year. Um, so yeah, that's budgeting in a nutshell. And what I've done is I've put an example together for you guys just to make it make it more illustrative for you guys and try and take you through how a budget is put together. I haven't not put it together and putting it together in the session because of time constraints. I've put it together already and I will explain it to you. Um, but yeah, I've got an example. So I've made this character being Jane, and Jane's going to take us through our whole sort of webinar today in terms of her budget, her payroll, what she does, and the taxes that she pays based on everything that she earns. So, who is Jane? Jane's a 35-year-old female. She lives in Cape Town. She's a financial accountant living in Cape Town, and her monthly salary is around 30,000 after deductions and PAYE, UIF, and all those things that I'll show you guys in the payslip portion of our webinar today. Um, and Jane also has a side hustle. So Jane, she's been interested in jewelry, and a few years ago, I started selling jewelry online, and now she's grown into this booming business. She's now been able to rent a space in Cape Town, and she sells, and her sales for the month vary around 15,000 Rand a month, based on the time of the year and the influx of sort of orders and things that she gets. But she's now doing it online and from her store. And Jane's been good in the sense that she's told the company as well, look, I do have a side business, and they've allowed her to continue with that after hours as long as it doesn't affect her 8 to 5 job. Um, so yeah, just to pull up a budget that I put together for Jane. Uh, I hope this is not too intense for you guys, but basically what I've done with the budget, I've put together a budget which includes her individual income being her salary, a budget that just is her individual income without her side hustle, and then a business budget, just for illustrative purposes. So this might be a lot of numbers and might be big numbers, but I'm trying to take you through it as best as I can. So basically, when you're putting together a budget, it's good to do it month on month. Um, so you'll see like column B in this Excel is a full year's income and a full year's expenses, but month on month, we've broken down her income. As you see in her salary is at 30,000. She does have a little bit of savings in the bank, so she earns a little bit of interest income. And then her side hustle income, as explained, is 15,000 Rand a month. So all in all, she's earning about 45,000 Rand a month. And for the year, she's coming out with around 550,000. And then her expenses based on that. So Jane has, I mean, she's renting in Cape Town. She's paying water and electricity. She's paying for her own medical aid, um, transport to get to work and back. There's a cell phone contract, there's subscriptions, and just the normal sort of basic expenses that she has just to run her life. And how she's derived that, she's used her income and tried to make it work for her. So she hasn't gone and overspent or over budgeted on expenses. She still has as you can see, monthly she's earning 45 and she's only needing to spend 36. So what is she doing with the rest of her money? She's gotten into savings. So she's got an emergency fund saving. She's got retirement savings, which is very important for anyone, whether you're young, old, whatever sort of position in life that you are. It's always good to have retirement savings in your bank. And then other savings and investments, she dabbles in the stock market now and then, and she sort of plays around with 800 Rand a month. And that sort of earns her a little bit of interest as well. But as I said previously, it's always good to put a budget together, but then also track your actuals against that budget. So there's no point in just having a budget and saying, okay, in August, for example, I'm going to earn 45,000, I'm going to spend 36 and have saving expenses of 5,800 and then not know what actually happened in August, because then there's no way for you to actually track and say, okay, I was supposed to have savings of 5,800. I think I had savings of 6,000 Rand. I don't actually know, but let me get into September now. The best way to do this is actually in August, maybe pull your bank statement, see how much you actually earned against um, the 45,000, see how much you actually spent against the 36,000, see how much you were actually able to save in August. And then from there, maybe you spent a little bit extra on groceries. You've spent 4,000 Rand because now you've gone and bought, you got a sweet tooth and you've bought cake every single day for some reason or the other. And you spent 1,000 Rand extra on groceries for the month. And similarly for entertainment, you've gone and spent 4,000 Rand on entertainment. So you've overspent now for the month by 2,000 Rand. If you didn't actually look at that and actually compare that to what you budgeted, you would have just carried on, spending the way you're spending, because you always build a habit of spend, and you'll keep creeping into your savings budget, and you'll keep creeping into your excess funds if you don't actually track what you're doing. And by tracking or actually looking at August versus August, you'll see like, okay, I've overspent on groceries. Maybe I should cut back on the cake that I was eating. Maybe I should go out less this month, to reel back your expenses. So you then have, I think, a little bit more money for yourself, and then try and build your spend behavior in a positive light, rather than just sort of living in that sort of train of, okay, I think I've spent this, I think I've spent that, but never actually doing anything about it. We do have a hand. Can I take a question?
Tafadzwa, can you hold your question till the end? We will allow hands, and if you pop yours up first, we'll answer your question first.
Okay, perfect. So yeah, that's basically what a budget is. I mean, it's you putting together income versus expenses that you're expecting to earn for the year ahead, and then similarly tracking every single month against that budget. And if you're doing that religiously every single month, you'll see like you'll be able to improve your spending behavior. You'll be able to improve how much you have in the bank. You'll be able to improve how much you're able to put towards your savings. And as I mentioned previously, the 50-30-20 rule, from there you can try and build towards that ratio. Just make sure that you always have something in your savings, as I previously mentioned. You're always spending on yourself, because if you're working hard, I mean, it's good to put money aside to enjoy your month as well and spend on yourself. And then you'll always have needs. You'll always have, a bond or rent or electricity and water, depending where you're staying, groceries. I mean, people have to eat. Those are needs. There'll always be transport costs. There'll always be, you might have insurance for things that you own. So there'll always be these needs that you have to fill, and try and keep that to your 50% of whatever you're earning. It doesn't have to be 30,000. It could be 10,000 Rand that you're earning, as previously mentioned. But just try and keep your spend in relation to your income. And that's all I can simply say to you, as if you are putting a budget together. Just my other examples was just salary, or just Jane earning without her side hustle included, and that's a simple budget without any side hustle money in it. And then the business budget. So this is slightly different in terms of a format. So I'm not too sure how familiar you guys are with businesses and how they run, but they basically run on an income statement, and the general format of an income statement is what you would use to put your budget together. So you would have your revenue, your cost of sales, And then your other expenses, generally, that's as simple as what an income statement is for a business. And in this sense, so you've got side hustle income of, as mentioned in the budget, so she's earning 15,000 Rand a month. And if you look at how she's actually performed, it's fluctuated every month, but ultimately for the year, she's earned 195,000 because she's had better months than what she expected, and some months were worse, but overall, she's now earned more in her side hustle. So you can see, like, actually tracking that, you would have been able to see for the year, okay, I've earned a bit more, I've spent slightly more because I've had to sell a bit more, but overall, I've come out with a bigger profit of 42,000 instead of 33,000 for the year. And the only way you would know this is by tracking your actuals versus your budget. So yeah, if there's any sort of key takeaway from this, keep your budget simple. Um, Try and make it work for you. So always plot your income first and then let your expenses run off your income. Try and keep it to the 50-30-20 rule if you can. If you can't, it is one of those things, but just make sure some of your money is going towards savings because that's very important, whether it's retirement savings or into a savings fixed deposit account or savings account in your bank. Let it build, let it work for you, and let it earn interest for you. Um, and then ultimately, you'll always have needs, as mentioned, and as well, just make sure you are paying yourself and enjoying your money as well. Don't just make it be sort of very formal in the sense that you only pay for your needs, you put everything else in savings, and you're living sort of miserably in a month. It's always good to have a bit of money and a bit of fun as well. Um, Yeah, and then moving on to our next topic, and why I've chosen understanding payslips as the next topic is basically how we've built the budget. As mentioned, we start with income, and where's income derived from? Generally from payslips. And a lot of people, when they look at their payslips, may not understand, and I've seen it with working with people that are not in finance. Some people do not understand how payslips are drawn up and why there are certain deductions on payslips and what do those deductions actually mean. Um, so the key sections on payslips. So what you would see on a payslip generally, for those of you who have seen a payslip, so you'd have your employee details, employer details, just very basic. The period in which you're being paid. So if you're being paid this month, it'll have like June 2025 on the payslip. It'll have your earnings, your deductions, and your net pay. Um, and then your income components generally on a payslip. So those would be things like your basic salary, which will be your contractual amount that you signed with the company for. There'll be commission for those of you who are into sales and are selling items for a company. You might earn a bit of commission. There's bonuses involved, annual bonuses or performance bonuses based on the company that you're working for. You might have a bit of overtime on there, and that would be for companies that do pay overtime, where you track your hours that you work and you're able to charge it back to the company. And then you have things like allowances, fringe benefits. There's might be a bit of night shift, day shift allowances that you get for those of you who work irregular hours as well. So those are the different type of income streams that you may see on a payslip. The deductions. So deductions generally are broken down into statutory and voluntary deductions. So your statutory deductions, these are your mandatory deductions by law. And the big ones that you will see and you'll always see on a payslip are your PAYE, which is your pay as you earn, which is basically the tax that you pay to SARS. You will see UIF, which is Unemployment Insurance Fund. So what UIF is, and I'm sure many of you have seen this on your payslip, it's basically 1% of your salary limited to a certain number, which is contributed by yourself and by your employer. And what it is it creates a safety net for workers facing unemployment, illness, maternity leave, and the contribution benefits employees by providing financial support during these periods. So to put that in basic terms, some companies, when you go on maternity leave, may not pay you a salary. That may be like an unpaid leave that you have to take. Um, because of this, there is the unemployment insurance fund that you can apply to and tell them, look, I am on maternity leave. Obviously, you have to provide them with the proof that you have been on maternity leave and that your company isn't paying you or is paying you a fraction of your salary. And if you're able to prove that and submit all the documents as required, they will pay you a certain amount out of that unemployment insurance fund. So that's generally what the UIF deduction is for. And then you'll also see an SDL deduction on your payslip, and that's a skills development levy deduction, and that's 1% of your your salary, which is contributed by the employer. And basically, what the skills development levy is, it kind of tries to promote companies to train their employees, and companies can claim back 20% of their total contributions by keeping. I think this is one of the harder things for companies to do, is keeping a track of all their training that they do for their employees and a plan of their training for their employees, and then submitting that to the government to get their 20% refund of their SDL contribution. So I don't know many companies that actually keep a track of the training that they do of employees, but there are certain that do. And if they're able to provide the necessary information and keep proper tracking of their training expenses, then they do get their 20% deduction back. And then your voluntary deductions, these are things like retirement fund contributions. There'll be medical aid contributions by some employers. You might have like a group risk deduction. There might be loan repayments that you might have taken out from the company, and so on. And there's also like fringe benefits. I don't know how many of you would be or would know about the fringe benefits part, but there might be like a company car involved. There might be low interest loans. There might be free accommodation. There might be gifts and incentives for good performance by the employer that comes to you, all of which are taxable as well. And then gross income versus net income. So you may see like a gross income figure on your pay slip and a net income figure. All that means, basically, gross income is your total earnings before any deductions, which will be like your salary, your bonuses, your benefits, etc. That'll make up your gross income. And then your net income is basically the amount that is actually paid to you after all the deductions are paid, the amount that reflects on your bank statement. And then understanding payslips. So understanding PAYE on payslips. So as mentioned previously, this is a statutory deduction. It is basically tax that you pay over to SARS based on the amount that you earn. And it's a progressive tax, so it's based on a sliding scale in terms of the amount that you earn annualized and then put into a tax bracket. So if there is a component or a tool that I will tell you guys to take down, there is a website. If you go onto Google and search for tax term, it'll pop up with different calculators that you can use to work out the tax and work out your net income. And all that you will see on TaxTerm is salary tax calculator. If you click on that, it's very simple to follow. It will basically ask you for your monthly income. It'll ask you for your age and then the period that you're in terms of a tax year. So you populate all of that and it'll work out your net pay basically. And I always tell people, use that as yes, thanks, Amy. Use that as when you're getting into a new job, use that as your benchmark. So always ask them, when you're getting into a new job, ask them for a mock pay slip. That's one of the biggest things, because you'll always sign with a company based on gross salary. So you might be signing for 15,000 Rand a month, and you might say, oh, okay, cool. That's a bit more than what I'm earning now. I'm going to take the job. But then once you put it into TaxTerm, for example, you realize, okay, no, I'm actually only going to get paid 12,000 Rand. And I was previously earning 10,000 Rand untaxable because I was below the earnings to be taxed. And I'm actually only earning 2,000 Rand more for a hell of a lot more work. It might not be in my best interest. So these are sort of tools and tricks that you can use in order to better your life. It's always not just about more money. As much as it is about more money, it's also about having a work-life balance. It's also about making sure that you're okay as well. And then the common mistakes that you sort of see on payslip. So what I have seen over the years, there might be an incorrect calculation of your PAYE. You can use the TaxTerm website now that you have to verify that the tax that you're getting charged is actually correct. Sometimes the company may not include contributions to medical aid and pension funds as fringe benefits, even though they should have. And there could be an over or under deduction of voluntary benefits on your payslip. These are sort of common mistakes that you need to look out for on your payslip. And And then just why is it important to understand your pay slip? So it helps, as I said, with budgeting. This is where your income comes from. If you're in a normal salaried job, the pay slip sort of defines what you can spend on ultimately. It helps plan your monthly expenses, as mentioned. And so your loan applications, your banks always ask, if you are looking for a loan, the banks always ask for 3 months of pay slips, 3 months of bank statements, and so on. And that's why it's very good to understand what's sitting on your pay slip. Um, it also helps with tax planning, so you'll know which sort of bracket you fall into. Salary negotiations, if you're going into a new job, if you really do not know what a pay slip looks like, it's hard to start the salary negotiations with a company. And employment contracts, it's as I've mentioned previously, you always get offered a gross salary when you're signing with a company. It's always good to know that a net is what you actually get paid into your bank account. So understanding your payslip from that regard is very important, because then you can actually start negotiating with your employer or potential employer around the net value. And they might actually think, you actually know what you're talking about, and allow you to earn a little bit more because you might come with a little bit more experience. What I've done is I've put together a very basic payslip for those of you probably possibly have never seen a payslip. This is Jane again, and she's earning a salary of 30,000 Rand, as previously mentioned. And how does that look in terms of gross? So Jane earns a basic salary, and when she signed up with this company, she got offered an offer of 37,000 Rand, or 37,126 Rand. And if you're using, or if you're on the Taxtim website, I will tell you, maybe plug Jane's age in at 35, and you'll see it'll come out with this 30,000, around about that figure, as a net pay. And the deductions that you'll see on there, as previously mentioned, so you've got your PAYE, which is worked out based on the tax tables. You've got a 1% for UIF, limited to the 177 Rand. And then you've also got employer contributions, as previously mentioned, UIF and SDL. And ultimately, her total deductions worked out to around 7,100. And she took home 30,000 Rand, or she takes home 30,000 Rand a month. So that's basically what the payslip looks like in terms of numbers. And then just at the top of your payslip, on anyone's payslip, you will get your information, as previously mentioned, the company's information. You might have, as I've got here, like bank account details of the employer, or of the employee, sorry, the month which you're working, or the period which you're being paid for, and maybe a start date. There'll be other sort of information. They might have your address on there. They might have the company's address on there. It differs from company to company, but basically this is what you would see on a payslip. Yeah, so moving on. So managing debt wisely. So
Sorry, Darren, just doing a time
yeah,
check. We've got 10 minutes left.
okay. So we keep into the 1 hour. Okay. So let me try to get through the rest of it very quickly. So managing your debt wisely. So why I've chosen this is because debt is something that creeps into everyone's lives. As I said previously, you have things that happen in life that you might need money now, and you don't have it right now. So you would apply for a loan, for example, which you would use your payslip for, you'd use your bank statements for, and that's why I've sort of gotten things to work in this manner. So credit is the ability to borrow money now and in an agreement to pay back later. Obviously, there might be interest charged on it. Your common types of credits are loans, personal, home loans, student loans, depending on what the loan is for. You get credit cards, there's store cards or store accounts, which is one of the worst type of credits to take out. If I had to give you guys any advice on managing credit. And then there's overdrafts. So basically understanding different types of credits that you get. So you do get personal loans. These are basically loans that are borrowed at a fixed amount, and it's repaid in installments with a bit of interest charged on it. And if you're taking out a loan for 100,000, you might end up paying it over 5 years and end up paying back about 125,000. So that's how the loan sharks or the banks earn money on you taking out a loan. You do get credit cards. So these are sort of revolving credits. You can borrow up to a set limit, and it's sort of a repeated credit that you can roll year or month on month, and it usually has a set interest-free period. So it could be around 30 days to 55 days. And in that period, you won't be charged any interest. So you're kind of using money in advance, but then make sure you pay it back within that interest-free period so you don't get charged extra. And then, as I mentioned, store credits or store accounts, which will be like your or which will be like your Woolworths, your Ackermans, your Mr. Price, your Truett's store credits, and that's typically charged at the highest interest rate that you can possibly get. And that's why I say always try and stay away from store credits. For those of you who do have store credits, I would say pay that off first because that's generally the highest interest that you would be experiencing on any of the debt that you've taken out. The cost of borrowing. So you get your interest rates, which are percentages charged on the amount that you borrow. And then there's also compound interest. I don't know if any of you heard of that, but compound interest is interest basically charged on interest. So the longer you keep your debt outstanding, the more interest you'll get charged. And then typical sort of interest rates that you get charged in South Africa. So personal loans range between 12 to 27%. Credit cards range between 10 to 25%. You get store accounts. Store accounts are between 15 to 22% interest, and home loans and sort of car loans are usually linked to prime, and which is around 11.75% currently. And also student loans. Student loans are one of the lowest interest loans, but obviously with student loans, you can only use it towards paying off academic studies. And then credit scores, something that feeds into debt. So why is it important, or what is it? So credit scores are basically, it's a 3-digit number that's based on how you've spent money over the years, and it takes into account payment history, your debt level, your credit history, the types of credit that you've taken out over your lifetime, and any new credit application. So why does it matter? So the higher your score, the better your interest rates you get offered, and the better your chances of being approved for loans. The poorer your score, obviously, the more possibility of a denial for a loan, and also the higher interest you get charged on the loans that you do get approved for. Employers also do look at credit scores, especially if you're in a financial position. They do look at your credit score to make sure that, if you can manage your personal finances, then you can probably manage our company finances. So that's something to think about if you are in sort of a financial position. Landlords as well, if you're looking to rent, they do look at credit scores, and any sort of loan shark do look at credit scores. So it's always good to try and keep your credit or your credit score high. So just pay off your loans. The way to maintain a good credit score, I would say, is to just pay your bills and debt on time, keep your credit card balances low, avoid unnecessary store credits. As I mentioned, store credit probably one of the worst, and don't apply for credit too often, because the more you apply, the more chances of your credit score decreasing and the more chances of you getting denied credit. And then savings and investments. So basically, this is more, I wanted to touch a bit more around like investments in terms of retirement savings, which is very important for anyone, whatever age or whatever space in life that you're at. Retirement savings are always important because you don't want to end up working for your whole life. You want to have some sort of freedom towards the end and be able to draw down on different retirement savings. Here I'll touch on tax-free investments, retirement annuities, and pension or provident funds, which are similar. So just to get into tax-free investment. So the pros of a tax-free investment, or what is it? So a tax-free investment is basically an investment that you make, which is tax-free in the sense that you earn interest at 0% tax on that investment. The pros of it, there's no tax on the interest, dividends, or capital gains. Withdrawals are 100% tax-free. It's flexible, meaning you can withdraw it at any time. So you can start your tax-free investment today and withdraw it tomorrow. So that's a pro of having a tax-free, and it's actually good for medium to long-term goals. The cons of it is there's no tax deduction on your contribution. So where a retirement annuity, for example, will reduce your taxable income, a tax-free investment will not. There's strict limits on a tax-free investment, so you can only contribute 36,000 a year towards a tax-free investment and 500,000 over your lifetime. And generally, tax-free investments, as much as they are designed for retirement, they're not specifically a retirement fund. They're best for people who maybe have already maxed out their retirement contributions, or are parents saving for children, for children's educations. You can use a tax-free investment for that. Or any investor wanting sort of flexibility and tax-free growth. Then onto retirement annuity. So retirement annuity, the pros of this is that the contributions towards the retirement annuity are tax deductible, and you'll see that in the tax calculation that I get you into just now. Investments grow tax-free inside a retirement annuity. It encourages disciplined savings because with a retirement annuity, that's only accessible at retirement. So if you started today, it's not accessible tomorrow. You're going to have to leave it in there and let it grow and let it mature, and only then be able to touch it or use that money at your retirement age or at 55 years and over. And it's also a pro of retirement annuities is that it's not linked to an employment. So you can have this happening in your personal capacity, which is something that I promote for you guys to do. The cons of it is, as I've said, if you do need the money tomorrow, you can't touch it because it's kind of locked in. And at retirement, you can only withdraw 1/3, and the balance of 2/3 are paid to you as an annuity, meaning it'll be paid to you monthly based on the number of months that you want it to work for you.
But this is my assignment. I am unmuted.
And then you've got your pension and provident fund. So pension funds, the pros of this is that these are sometimes offered through your employer, and you and your employer can contribute towards the pension fund. The contributions, again, are tax deductible. It's an automatic savings that's linked to your salary. It can be deducted as part of your salary and as part of your deductions on your payslip, so that you don't have to do this in your personal capacity. But the cons, obviously, it's not portable in the sense that you must preserve your funds. So if you, for example, get retrenched or you resign from a company that gives you a provident fund or a pension fund, you have to then either withdraw it at that point or let it mature and move it to your next company that you go to. And the tax withdrawal you get taxed on it as well when you withdraw the money. But this type of investment or this type of saving is good for employees of companies that offer pension funds, individuals needing structured sort of religious savings. This will ensure that you get onto a debit order every month and force you to save money towards your retirement. The key takeaways of the three. So if you're looking at a tax-free investment, it's great for tax-free growth and flexible savings, but obviously no upfront tax break. And a retirement annuity is a powerful tax-deductible savings vehicle for individuals, not through an employer. And a pension fund, as mentioned, it's best for employees who have an employer who's also contributing on your behalf. So early withdrawal, as you see on the screen, what does this mean? So as I mentioned previously, if you do resign from a company that offers you a pension fund, or if you do get retrenched or dismissed or whatever it is, that money that's been contributed towards your pension fund is your money. It's not the employer's money. Even though you've been dismissed or retrenched or whatever it is, that money is yours. So it's yours to withdraw at that time or to keep it in the investment and then move it to the new company that you go towards. The pros of early withdrawal. So it's immediate cash flow. So for example, and you'll see with Jane's example that I put together, it's immediate access to cash flow. You're not locked in. It offers a debt reduction. So meaning that if you do need the money at that point in time, withdrawing it would make sense because you need to pay off a high interest loan or you need to settle credit cards or personal loans. And if it's used in a wise manner and not just used for entertainment, for example, then I would say go for it, do an early withdrawal. But the cons of it, obviously, there's a lot of tax that's charged on withdrawal of a pension fund. You lose the compound growth of it, and I'll show you what that might look like. If you withdraw it today, you sort of you're putting your retirement on hold a little bit because you might end up being able to save actually a million rand more by keeping the money in just because of compound interest. And I'll show you what that looks like now compared to withdrawing it today. And there's reduced future pension. So those are sort of some of the pros and cons of early withdrawal. An example that I've put together, I do have it on Excel, I'll share with you quickly. So yeah, in this example, I've got Jane again. So this is sort of keeping it in. So Jane withdrawing the money today, So say for example, Jane's been with the company for the last few years, and she's been able to build up a policy or pension fund of 100,000 rand today. And she some reason or the other now she resigns or she gets dismissed. So withdrawing the money today would mean that Jane gets taxed 13,500 rand on the 100,000, and she'll only come out with 86,500. Now I don't have that on the screen currently. I'm just talking you through this part. But that 86,500 is all she'll have today, and she'll start again on zero from going forward when she gets into a new company and starts her pension fund again. But if Jane does keep the money in the fund, so you'll see she has 100,000 today. That's where she started. Every month she contributes through her employer 500 rand, and every year that monthly contribution grows by 5%. So you'll see at the end of 2025 she'll have 115,000 rand. When she gets to when she's 65 years old, she'll have 3 million rand, or just over 3 million rand, based on compound interest and so on. But if she had to withdraw the money today, meaning she starts again on zero. So as you can see, 2025, she started again on zero. So at the end of the year, she only had 6,500 rand. Now bear in mind, she does have the 86,500, which she's now paid off some debt with. But at the end, at age 65, she only has 1.6 million. So you can see the difference of compound interest and what the 100,000 has done. So she's actually shot herself in the foot a bit, because she's now come out with around 1.4 million rand less at age 65 in the year 2055. But you can see, like, just keeping that 100,000 rand in, she would have earned an extra 1.4 million rand on that 100,000. But if you choose to withdraw it today, that's why I say it has to be wise. It has to be a reason why you're withdrawing it today. It has to be either to pay off high interest debt, or getting into sort of other investments or better opportunities. If that's the reason you're withdrawing it today, then sure, go for it. But as you can see, like, it's real life example, just keeping that 100,000 rand in the bank or in the pension fund, you'll come out with just over 3 million rand at age 65. Obviously, depending on when you want to retire, etc. If it's age 60, you're coming out with 1.8 million. But you'll see, like, just working for an extra 5 years as well has a big impact on your retirement savings. Not saying you need to work till 65 and have your pension fund running till 65, but obviously the longer you keep it in, the more growth you get on your funds. So yeah, in terms of how to know which investment to go for. So again, you have to plan your financial goals. So you'll have your short-term, medium-term, long-term, and your retirement goals, and that will determine sort of what sort of investment you look at, and it has to match your life, the stage of your life that you're in. So if you're a student, maybe you want to build an emergency fund or open a tax-free investment account. If you're a working professional, maybe you want to maximize your retirement fund, and you can supplement that with a retirement annuity or tax-free investment. If you're self-employed, you might want to open up a RA. If you're a high income earner and you want to reduce your tax, it'll be good to open up a retirement annuity. And if you're nearing retirement, then it's all about focusing on preservation and trying to push as much as you can into your retirement funds. Your best use cases. So it depends on what you want, I think. So if you want access to money regularly and tax-free growth, then you're looking at possibly opening up a tax-free investment. If you want to be locked in and have tax relief in the short term, then you can look at opening up a retirement annuity. If you have an employer benefit, then that's going to be moving towards a pension fund. If you want long-term flexibility, then you're looking at sort of unit trusts and stuff, which I haven't actually touched on, but those are more long-term and flexible savings. And in the short term, if it's just an emergency fund, you might want to just open up sort of a savings account within your bank account, just pushing money towards that and earning a bit of interest on that. And then finally, I wanted to get into tax and how all of this sort of builds into your tax and how tax works. This might be one of the more complex topics that I'm going to touch on today, but I think it's important for you to understand how earning a salary of, say, 30,000 or 37,000, as you saw on Jane's payslip, what impact that has on the net income she takes home, how she could reduce her taxes in terms of maybe taking out a retirement annuity and getting a tax refund from SARS. So yeah, basically what is personal income tax and who must pay it. So personal income tax is, as you know, tax levied or money that is paid over to SARS based on the amount that you earn. Who has to pay it? So if you're 18 years and older, if you earn above the annual threshold, or your income is not fully tax payable through your PAYE or through your employer, then you have to register and pay tax. The thresholds, as I mentioned, so if you're under the age of 65, your threshold to not pay tax would be earning anything less than 95,750 Rand in the year. If you're between the ages of 65 to 74, your threshold is earning anything less than 148,217 Rand in a year. And if you're older than 75, then your threshold is 165,000. So earning anything less than that, based on your age, you won't have to pay tax. But as soon as you earn anything more than that and you're over the age of 18, that's where you need to start paying tax to SARS. Tax is also, how is it calculated? So it's based on the tax tables. I don't want to get into the detail of that, but as I mentioned, you can use the Taxton website that Amy has posted on the chat, and that will sort of give you around about what sort of tax you're looking at paying based on the income that you're earning. There are primary rebates, and these are based on your age again. Your primary rebates you're looking at if you're under the age of 65, SARS gives you a deduction or a rebate of 17,235 Rand. And again, between the ages of 65 and 74, you get an additional 9,444 Rand. And if you're older than 75 years old, you get another little bit of 3,145 Rand. Those are all deductions from the amount that you need to pay to SARS. And then you may know about PAYE versus provisional tax. So PAYE is where your employer deducts tax monthly from your payslip. So you would have seen, or you would remember on Jane's payslip, she was kind of earning a salary of 37,126 Rand, and she took home 30,000 Rand. Basically, that 6,900 or 7,000 Rand was the tax in the form of PAYE that was being paid over to SARS by the employer. And then you got provisional tax. So provisional tax, this is more for self-employed or some self-employed people or companies. This is where they need to sort of submit an IRP6 twice a year and pay SARS twice a year based on their projected income for the year. And if you are a provisional taxpayer, you earn income not subject to PAYE, and that's why you need to pay tax over in this manner. Tax efficient structuring. So as mentioned previously in the retirement section or the savings section, you do have retirement annuities, which help you reduce the amount of tax that you pay to SARS. If you're on medical aid, you get medical aid credits or deductions from your tax payable to SARS. If you have a home office, you are able to deduct the expenses in that criteria if your expenses meet the criteria for home office deductions. And then there are travel allowances as well. If your company gives you a travel allowance, that is deductible from your tax income as well. And then how to file. So you may or may not know, tax season is around the corner. It is starting now in July, and a lot of you will sort of need to log in and submit your tax returns. And that's why I thought this is quite a nice topic to end with, so that you guys go off and you know what to do when you're filing your tax. So when filing your tax returns, go onto your SARS website, log onto your profile. I see someone is sharing, but
I think they stole the screen from you. You can steal it back.
Oh, sorry. Yeah, got it. I think it's up, but yeah. So yeah, just log into your profile. You'll see there'll be a returns issued section on your SARS profile. So you need to read. So obviously, if you've done this before, you will notice that your tax return is already pre-populated based on the income that you've earned, maybe interest that you've earned. You might even wonder, how does SARS know some of the stuff that's on there? It's actually all filtered in from the companies and from your investments and the interest and stuff that you earn through the banks, and all of it filters into your tax return. And then from there, you just need to sort of vet the information and make sure that it is correct. Some of the times, SARS might not know about your side hustle income, because that's income that's earned sort of off the books. There's no sort of return that's done for that. So you can avoid it, or you basically not putting it on your tax return is tax evasion, which is illegal. So including it in your tax return is probably the best route to go. But then you can also put in your expenses towards your side hustle, which will reduce the amount of tax that you pay as well. So if again, looking at Jane, she used to sell jewelry on the side. She made 195,000 in the year. But she had also business expenses of 160,000. So she can include both of those in her tax return so that she's not paying tax on the full 195. She's only paying it on the balance of 35,000 for her side hustle. And basically from there, you just submit it before the due date. Once you're happy, there should be a submit button on the return. Once you submit it, just obviously before you submit, just make sure everything is correct and you're happy with the amount or the deduction, or the refund that SARS owes you, and then from there, just submit it. And then there's also something recently over the past few years. I don't know if any of you are aware or have seen this, but there's an auto assessment now that SARS does. This is sort of SARS trying to get people out through the system as quickly as possible. So what they do is they kind of people that don't have fluctuating income year on year and are quite simple to do their and have quite simple tax returns. SARS are able to auto assess you, so meaning they will do the tax return for you. And remember, you need to check that thing carefully because it can be incorrect. As I mentioned, they won't have your side hustle income on there. But they will think that that's all that you earn without the side hustle, and then not checking it or not responding to the auto assessment means that you're happy with it, and that's the incorrect way of doing it because they might have missed something that could actually earn you a big refund at the end. They may not have your retirement annuity on there, for example, which could end up with you earning a refund, whereas now SARS are basically telling you that you owe them money. So it's always great to just make sure that you're checking your assessments, even if it's an auto assessment, which is much easier than a full return. But just make sure that you log in and that you accept it. And as I mentioned previously, if you don't accept it or you don't do anything about an auto assessment, it will automatically be accepted by SARS and will be filed for you. And then just the red flags or common mistakes. So as mentioned previously, not declaring your freelance or side hustle income is sort of tax evasion. So that is illegal. So please do put that in. But also remember, claim your expenses towards your side hustle. But with saying that, if you do get audited, if SARS does pick you up for an audit, you need to have the proof for that expenses that you claim. So if you're paying rent to a certain sort of a building that you're renting to sell the jewelry. So Jane would have to keep the rental invoices that she's paid towards. She'll have to keep her subscription invoices, all her material invoices that she claims. Because if SARS asks you for proof, how do you know? How do we know that you spent 160,000 and not 100,000? So then you're gonna have to keep your proof for that 160,000 because if it comes to it, and also remember you need to keep it for a couple of years, not just for the year that you're in, because SARS can start auditing you for 2024, and then all of a sudden ask you, okay, we're going to start auditing you from 2017 to date. So just remember that keeping your invoices for your side hustle as well is very important. Another red flag is ignoring SARS auto assessments, as I've just mentioned. So always remember to respond to those auto assessments because they could be incorrect. And then finally, I just wanted to take you through a tax example for Jane. Again, Jane has helped us a lot today. She's taken us through our whole webinar. So basically putting this together was her salary at 30,000 Rand a month, so annual salary of 360,000. She has a once-off bonus or annual bonus of 15,000 in the year. She does have interest income, and as I mentioned, do include your side hustle income in your tax returns. It's very important to keep that in. And then there are deductions which SARS could miss, as I mentioned, but you'll see here her retirement savings was 36,000 Rand for the year. She contributed 3,000 Rand a month towards her retirement savings, and her business expenses were 153,000. Now remember, for the 153,000, Jane would have to keep the record of that 153,000 in case of an audit from SARS. If SARS audits you, it's not something to be scared of. It's just basically keeping all your receipts, all your supplier invoices, etc., and just submitting everything to them. And generally, more likely than not, you will pass the audit as long as you keep all your receipts for the 153,000, for example, and all your invoices for the 195,000, just to prove to them that this is what you sold and this is the expenses attached to it. For the rest of your your return, like your salary and things, there's always support for that. So there will be an IRP5 which will be submitted by your employer. The interest that you earn on your savings accounts over like 1,200 Rand, that will be picked up from by SARS through your banks. And even the retirement savings that should be picked up based on the retirement company that you're using to fund your retirement savings. So overall, gross income, as mentioned, 71,200. Total deductions of 189,000. So taxable income that she earned for the year was 382,000. And based on the tax bracket, so if you had to put that into tax term, it should give you an annual sort of tax base of 80,989 Rand. And then, as mentioned previously, you do get a primary rebate. So remember, Jane is 35 years old. She's younger than 65. So she does get a primary rebate of 17,235 Rand. So it's basically a benefit for you as an individual paying tax that SARS allows based on your age. And then she is on medical aid. So she does get 364 Rand a month as a benefit towards her taxable income. So total deductions that she's allowed by SARS of 21,600. So finally, for the year, she should have paid tax of 59,300. But if you look at her pay slip, and as mentioned previously, she has been paying tax through her employer of 6,900. And that equated to, for the year, 83,300. So for the year, now she's overpaid tax. And her final tax should only have been 59,000. So overall, she would be owed a refund by SARS of 23,900. So that's why I'm saying it's very important for you to check your tax returns and make sure it's correct. Make sure that all the income on there is correct, and make sure all the deductions on there are also taken into account. Because at the end of the day, you could get a nice big bonus of 23,000 Rand, as Jane has done, just by checking her tax return and making sure everything was on there correctly, and making sure the rebates have been taken into account, making sure medical aid is done properly, because sometimes SARS may not know that you're on medical aid or may have missed that you're on medical aid. Remember, this is all potentially system driven. There are people behind it, but some of it is a lot very automated and system driven. So there is potential for misses like medical aid, and there could have been a dependent on Jane's medical aid, but SARS could have missed that, which would have allowed her an extra, or basically double that as a deduction. So yeah, all in all, it's not hard to do any of these things. It's just basically good practice to bear in mind that you're in charge of basically all your own income and your expenses, and it's always good to make your money work for you. And the best way you can do that is to make sure that you're, as mentioned, saving for the future. You're trying to pay the least amount of tax as you possibly can through good saving techniques like using a retirement annuity, as we had in the example with Jane. And yeah, it's overall, it's up to you to make your money work for you. So don't overspend, budget wisely. Always remember, track against your budget. You check your actuals against your budget month on month. If not month on month, do it every second month or every third month. But just make sure you're getting into the rhythm of doing it ever so often, so that you're making sure that, okay, you expected to spend this much in those 3 months. You actually spent this. Okay, where were my downfalls? Where can I cut now for the next month or next few months? What can I put towards my savings? It's always good to take note of all of that and take stock of how you've performed against the budget. And your income, I mean, we've gone through basically everything, salaries, pay slips, your debt. Obviously, just remember, if you didn't take anything away from that debt part of the presentation, just remember, don't take out store credits, as much as it may seem very easy, and they all come at you with, oh, just take out this credit. You see, you want this t-shirt for 300 Rand, just take out credit and you can pay it off over 6 months. Let me tell you, that 300 Rand will end up being 3,000 Rand at some point, and you'll be paying interest on it at a very high interest rate. So try and stay away from those things. Savings, again, it doesn't have to be an elaborate savings like a retirement annuity, a tax-free investment. It can be a simple savings account that's just attached to your bank account, pushing money into there, just earning interest at whatever interest it earns. As long as you're starting somewhere, you're doing all of those things is just building good payment or good spending behavior. And if you're able to do that, after a year, 2 years of doing it religiously, you'll end up being being able to make your money work for you, and that's the most important thing, I think. So yeah, thank you guys. Thanks for listening to everything I've had to say. I hope it wasn't too much to take in. I've tried to make it as simple as possible, but with finance, or with financial literacy, there's so much to cover, and it's so complex in every sort of aspect that it's hard to make it very simple, because you miss some of the good stuff, I think. And yeah, if there's anything, just remember, just take 2 or 3 points away from today and try and improve yourself and where you are financially. So yeah, thanks guys.
Thank you so much, Darren. That was a fantastic presentation. I definitely have learned a couple of things today. And the one thing I definitely think you missed is people think that when they earn more, they will be able to save more. But you live
Yes.
into your expenses, you live into your income. And the more you earn, the more you spend. That's just a natural human tendency. So the discipline is what you need, regardless of what your income is, because even if you're earning 50,000 Rand a month, if you don't have the discipline and you don't have the practices that Darren has spoken of today, no matter what you earn, you will end up not in a good financial situation, even if you think that you're earning a decent salary. So thank you, Darren. I think some really important, pertinent issues here. Some of us are budgeting, but we're not putting our actuals next to it. So it's a mystery every month when we look at our credit
It's
card
kind of like
statement.
at the back of your mind, you think, okay, I'm doing the right thing, but you never know until you put it down on a page. Yeah.
So from my side, I really appreciate that. So let's open the floor, guys. Any questions for Darren? If you'd like to put your hand up, I will read your name and then you can unmute yourself just so we can have a bit of order. If you have any questions and you're too shy to put your hand up, you can also pop into the chat. If you have something specific, remember, Darren is not going to tell you what to do with your money. I think we've already given some helpful information. It's really up to you. So Joseph, what's your question?
Thank you for the opportunity. So just a background about myself. I'm a Catholic priest. So as a young Catholic priest, for that matter, yeah. Let me just expose my age. I'm 31, and I have this investment, Stanlip investment, which I invest each and every month. So, but the question that I have really, or my concern, is when it comes to tax. I don't have any tax number. And, as a priest, a Catholic priest, I live by, this, we call it an allowance, a monthly allowance that we receive. So like there's no specific, like maybe a pay slip or things like that. It's just a stipend that you receive monthly. And should I be worried about tax? Should I be worried about it? And also, because each and every month with my investment, that I actually invest with Stanlip. So should I be worried? Yeah, my question is like, should I be worried about tax? Thank you.
Thanks, Joseph. But so basically, it depends how much your stipend is. I know you don't have to, obviously don't say it out loud, but like how much it is monthly and then how much it equates to annually, 31. So your annual, your threshold for tax is 95,750 Rand for the year. So if your stipends are anything less than that for the year, then you don't have to pay tax. So you don't have to register for tax. If you're earning a bit more than that, then I would say, if you're earning not much more than that, then I would say carry on, but cautiously, because you are going to have to register for tax at some point. With this, it's not something that pops up stuff. It's something that's paid into your bank account directly, I would assume, or given to you as cash. So it's not something that SARS tracks essentially. But to be like a good citizen in South Africa, I would say if you are earning over the bracket, just register for tax, because at any time SARS can come in and say, "Oh, Joseph, you're 31. You're not 18. You're not younger than 18. What do you do for a living? How do you make ends meet?" And then all of a sudden now your income is exposed. You're paying tax for 10 years now because you need to catch up for the last 10 years. So you can actually be very much out of pocket if you don't pay tax now. But yeah, I think it all comes down to how much you're making annually. Your investment, it depends how it's growing and how much is sitting in there. And then that would probably pull through into your into your IRP5 when you do file your tax return. But for now, I think you could be okay, just depending. I think it's more based on the stipend that you're earning that you should be more worried about. If that's less than 95,750 Rand in a year, then I think you're good.
Thank you, Joseph. Thank you, Darren. So, Joseph, you can take your hand down now. It will be an old hand. Tumelo, you are next. Oh. Ivan, I'm just muting you. Tumelo, do you have a question for us? Tumelo, the window is closing. It's closing faster. And it's gone. Okay, Likayla, I see you have a hand and you have questions in the chat. So your first question is, how do we motivate individuals to save in a culture of instant gratification?
Yeah, okay.
That's a very hard question to
Yeah,
answer.
that's very hard. So when you say individuals, or who are you referring to?
I would imagine we are talking about oneself. Maybe children as well.
Yeah, that's what I'm probably thinking. Instant gratification, I wouldn't say there's any real instant gratification for savings. It's always sort of a monthly gratification that you get when you see a little bit of interest coming in, or an annual gratification you get based on the interest that you earn on any sort of savings. If it has to be gratification as such to motivate your children to save, it could be something that you do out of your own pocket, like maybe take them out for something to eat, or I don't know. It's all up to you, I think, in that sense that no one's going to give you instant gratification for saving. It's more, and if it's for yourself as well, it's like you need to know that you're saving for yourself, for the future, for your future self, I should say. Because putting money aside is it's one thing, but letting it grow and keeping it in, as you saw with the example of the 100,000, just keeping it in earned an extra 1.4 million Rand. But taking it out at that point, you're earning 1.4 million Rand less at retirement. So I would say there's no instant gratification, but if it is for children, and if you're referring to children, then maybe it could be something that you do out of your pocket that gives them gratification for putting money aside, and maybe they have a monthly allowance and they give you a little bit back so that you can invest it for them, and then just motivate them to keep doing that. Start them from a young age, I would think, and then as they get older, it'll become part of what they do. So yeah, I hope that answers that.
And yes, just to add to that, Darren, I would definitely say in a world of YOLO, it's very, very difficult to not rob your future self. So you have to remember every day that you spend your current money and you don't save, you're robbing your future self. So you don't want to end up reliant on your children one day or your family members to support you when you are young and able-bodied now, earning a good salary, whatever that is, you're earning. So money is coming in. What you do with it to take it out is, as Darren said, completely individual. And there's no amount of principles that we can share with you that can help you to control yourself other than yourself. But thank you, Darren. I think the next question from Michaela was kind of building on that. What are the most important financial principles every young adult should understand? I think you've touched on that. Save.
Yeah,
even
save
if you
for your
earn 10
future
Rand,
self.
put 1 Rand away. If you teach those principles very early, that money saved is forgotten, it's very easy to be very safe in the world in which you create for yourself, because you've provided for your future self and for your emergencies, because you've forgotten that that money actually is there. Like that 10 Rand you find in those jeans, and it's a bonus.
Yeah, exactly. But yeah, just to add to that, Amy, it's like, don't live your life to impress others. Like that's the YOLO effect, I would say. Like you want to be cool and you want to buy the next hot sneaker that comes out for like 3,000 Rand, but in actual fact, you could have just carried on wearing the one that you have and then put that 3,000 Rand towards your savings, and would have benefited your future self, instead of thinking that buying that sneaker is going to make you make you be appreciated by others, or living your life to think that other people are looking at you and admiring you. In actual fact, they don't probably even care that what shoes you're wearing. So, just in terms of a young adult, just save, use your money wisely, make it work for you. Obviously, and one of the biggest things is just also enjoy it. Don't, as I've said throughout my presentation, you are working, you are putting money away as well. So the balance that you have, use it for yourself in the month. Do stuff that you enjoy doing as well. But as I said, don't live your life to impress others.
If you can name me one of your sneakers that you had 10 years ago, I'll be very surprised. Unless you still have them, which is also very impressive. But that is how trivial material things are. We buy them, we make ourselves feel very, very guilty about it, and we actually forget about them 10 years later.
Exactly.
But you still have to live with yourself 30 years from now when you're poor and you don't have those sneakers anymore. Okay, Likayla, I'm going to assume your hand is old as well, if you don't mind. We'll move on to Nozipho.
Good evening, everyone.
Hi, Nozipho.
I would like to find out, at work I can see they debiting a little bit of 1% towards SDL. Okay, based on payslips, on a topic for pay. They deducting that 1% monthly. However, I just completed my HR management with you and IQ. And I was paying by myself. I didn't ask for assistance from them. I paid it by myself. So I don't remember for them doing any courses that, like, even if it's first aid, how do they use this money? Because they are there's not no one is, they're not training.
Yeah, they're not paying you back. Yeah, I get what you're saying. So just remember, STL is not something that you as an individual or an employee uses in a company. It has to be something that the company approves. So if you've done this course through IQ Academy and it wasn't something that was approved by the company, it wasn't something that was pushed by the company, then they wouldn't pay for it. But if it's something that was approved by the company, they would pay for it or pay a percentage of it. And then the SDL is for the company to claim back from the government, for example. They are able to claim back 20% of the contributions that they make on behalf of their employees. So the SDL has nothing really to do with you as an individual, as an employee of the company. It's more if your company approved your studies and wanted to pay for it, pay IQ Academy for it, they could have done that. But if you've done it on your own terms and you've studied and you wanted to further your studies in your personal capacity, then you paid for it and that's on you. It's not that the company now needs to pay you back for it unless it was furthering your position in the company or it benefits your position in the company. Then maybe go back to them and tell them, look, I've actually done this. I've improved my knowledge around my job, and I can do a little bit more now for you. Could you then refund me for the course that I've done? Get into that sort of conversation with them. But the SDL itself, it's more a company claim back. It's a company benefit. They are contributing on your behalf, and it's not coming out of your pocket. It's just contributed at 1% of the earnings that you make. I hope that answers the whole question.
Thank you.
No problem.
So Nozipho, just to add to that quickly, we had a session around claiming from CETA and how businesses and individuals can do this. So your personal development must be discussed with your manager in your performance management meeting. And that is where you would say, I would like to study this course with IQ Academy. This is how much it costs. Can the company pay for it as part of my personal development in my job? And then they will pay from the CETA funding that they get, which is that SDL that Darren has spoken about. The CETA will then pay the company or they will pay the provider of that training. So it's important in your performance meeting that you have that discussion if there's something else that you're wanting to study in the future and you don't want to be financially liable for that.
Yeah,
Okay, thank you.
I did disclose it so that you won't be hold on the company. Should you resign, then you have to work so many years. Yeah.
Yeah. That's the way they
There's
trap
always
you.
that catch. Yeah, exactly.
You want the time back.
Yeah.
Thanks, Nozipho. Ivan, do you have a question for us? Ivan, have we lost you?
I'm here. Can you hear me?
Yeah, Bo.
Yes.
Can you hear me?
Yeah, we can hear you.
Okay. Yeah. Basically, I have two questions. My question is on debt, and the other is on SARS. Actually, they are just personal questions anyway. With debt, I was many years ago. Then I lost a job for at least about 8 years. Then then I couldn't pay that debt. Then recently I got work. Then I see my credit score is very poor. It's not improving. The only credit that I get when I apply for credit actually it's only on loans. And every time I paid up those loans, I don't see my credit score getting better. It's always down. I wanted to know how can you improve their credit score in terms of that, and what can I do in order to, because sometimes when I check on my credit score, I see that there's still records that I'm owing this, even though I have paid up such that. That's the question. And on SARS, it also it was about the pension. They once deducted the amount about 18,000, and that 18,000 you have said it was for the returns that I did not make previously. Then I approached them. Then I was told only it was for only 1 year, but later on I only found out, no, they tell me, no, you owe returns for at least it's about 5 years, and some of those years I was not even not. And I also called them and told them, no, I'm not because of the how long the years are, I cannot I'm not able to obtain those that information from those companies. So I wanted to know, what do I do? Because every time they send me correspondence and I see it showing there there's a refund, but you can't have the refund until this returns are processed. How do I get those returns? It's quite difficult. Thank you. Thank you.
Okay, so to answer the returns, remember every year that you once you register for tax with SARS, you owe them a return every single year after you register, basically, even if you're unemployed. If you're unemployed, obviously that return should show 0 on it, but it's still something that you have to submit every single year. So that's possibly something that's sitting on your profile, and it's something you have to activate. So basically, once you log onto your SARS profile, there'll be returns issued or returns history. In the returns issued section of your SARS profile, you need to just sort of open up your tax returns for the years that were missed or the years that you haven't completed. And then just go in there and complete them. And there won't be any information on there because you weren't employed, for example. But effectively, you just need to submit a 0 return for all those years. And then if they ask you further for any information, you can tell them, look, you weren't employed, or if it's for a company at the time that you were employed for, put in your income, put in the sort of deductions that you know that you can claim on, and then from there, just submit those returns. So as long as you're submitting something every single year, it must equate to obviously what's actually happening in your life in terms of the income that you're earning from those companies. But religiously, like if you can get into the motion of just submitting returns annually, you won't end up in a situation where now you need to go back 5 to 6 years and try and remember, okay, I earned so much in that year, I spent so much in that year, I had this sort of deductions in that year, therefore I should have paid this much tax. And then with that as well, if you have been working for those past few years, you're not going to have to pay a lump sum amount of tax for those few years. So it's always beneficial for you to do your tax returns every single year. And also, if you're not doing your tax returns, there's a potential of interest being charged for late submission, and that'll be added on top of the tax that you owe to SARS. So I hope that answers the second part of your question. The first part, if you can remind me again, what was?
It was about
The credit
that,
score.
the credit
Oh, the
score.
credit score, yes. Okay, so remember, in terms of your credit score, it's taken into account the history of your credit and how you've performed historically as well. So if those 8 years of unemployment and non-payment of debt is recent, it will take time to rectify that. So even though you're paying off your loans now, and just make sure that you are paying them off within in the period that the loan is interest-free, for example. So a lot of loans come out and it'll be interest-free for 30 days, and then you'll start paying interest thereafter. But as long as you keep paying those loans off within those periods, and you'll have to do so for the next few years. Unfortunately, you've had bad credit now for the last few years, so you need to rectify that over the next few years. Because remember, as I mentioned in the credit score piece of the presentation, it takes your payment history into account, it takes your debt level into account, it takes your credit history length into account. These are all things that contribute towards your credit score. It takes the type of credit into account and any new applications of credit. So the fact that you're applying for new credit is also affecting your credit score negatively. And the fact that you've had bad credit history for the last few years, you need to rectify that over the next few years. Unfortunately, it is a time thing now for you, and you're going to have to keep paying off your debt well over the next few years, and slowly but surely you'll see that your credit score turns the other way. As long as you keep paying off the debt that you take out, don't apply too often as well, I would say, because that's going to negatively impact you as well. So yeah, I hope that helps. But yeah, ultimately,
Yes.
don't take debt where you don't need debt. Like, try and stay away from it. Use what you have, spend within your means, and in that way, over the next few years, you'll see your credit score will improve.
Okay. Now, thank you very much. I'm pleased.
Thank you, Ivan. Okay,
Yes.
Priscilla, you are our last hand. Tumelo, unless you revive, we've given up on you. But Priscilla, there's still hope. What's your question?
Good evening, everyone. Am I audible?
Yeah.
Yeah, we can hear you.
Okay, my network is a bit unstable. Thank you so much for this eye-opening session. Mine is under the managing debt wisely. You mentioned a few interesting points there. The highlight is actually the employers look at credit scores. You mentioned that if you manage your finances well, you'd be able to manage those of the company. So I'm actually wondering of how does it impact, let's say maybe I'm applying for a job, maybe as a financial advisor in a company, and I do have a bad credit record, and probably I do qualify for the job, but because of the finances and bad management, will the impact be as bad to a point where I might not even get the position that I'm applying for due to the mismanagement of my finances?
Yeah, thanks for the question. That's a good question. So obviously, so not all employers or not all companies look at your credit score when they are employing you, but a lot of companies do, especially if it's like a financial position, especially like a financial advisor. If you're going to be advising other people on how to use their money, I would assume that company that you applied to will look at your credit score as one of the big sort of selling points for yourself. If your credit score is bad, there's a high possibility that that company may reject you, and they may not even tell you why. It might be that you didn't meet the criteria or something very generic, but you might be applying to multiple companies and not realizing that I have all the qualifications, I have all the experience, but why am I getting rejected? The companies are just giving me this random generic, sorry, we went with another applicant sort of reply, and you never know why you're not getting accepted. But it could well, in fact, be that your credit score isn't what they're looking for, or because it's so bad, they're obviously assuming that if you can't control your own credit, you're not going to be able to advise others on how to do so as well. So it's something that employers do, or companies do, but don't tell people necessarily that is the reason why you got rejected. But it is one of the factors that, especially for financial positions like financial accountants, financial advisors, finance managers, CFOs, all of those sort of finance positions in a company, they do generally look at your credit score as one of the factors when considering employment.
It's a tough world, Priscilla.
So again,
No,
with
much
your credit score, try and
appreciated.
improve it. If it is something that's now been bad for the last few years, as I said previously, it will take time to rectify. But once it is rectified, just obviously, again, don't take credit, don't take debt where you don't need it. Try and spend within your means again. And once your credit score is turned around, you will see that if you have the qualifications and the experience, you will get the jobs that you are applying for.
Thank you so much.
Okay, Darren, we have one question from the chat, which you can answer quite quickly if you don't mind. I'm just
I think
aware of
Tumelo's
time.
hand is working. I'm not too sure.
Tumelo is an old hand, and unless Tumelo, are you here with us, Tumelo?
He's unmuted. I just don't know. Maybe his connection isn't good. I'm not too sure.
If you can post in the chat, Tumelo, and then I'll read out your question. I'm going to take just a few more questions because I'm mindful of time. So Silas has asked, how can we be helped to submit our own tax returns?
How can we be helped on how to submit our own tax returns? So submitting your tax returns, it depends on how complex it is. It can be a very simple task. As I said previously, when you log onto your SARS profile and open your tax return, it's already pre-populated. Because SARS has information, as I mentioned previously, you might be surprised at some of the stuff that they know that you have and that you're doing and how it's populated onto your tax return, because they obviously have access to the banks and to your IRP5 and so on. And generally, once your income and your expenses are on the tax return, it's as simple as just reviewing and submitting. If you're not happy and need further advice, obviously, and you don't know, it'll be good to obviously consult someone that is more experienced in that matter. But I would say for now, it's hard to just give someone help if you don't know how to help them. But it is a very simple process, and SARS makes it accessible and doable by everyone, I think, because they do pre-populate. So it should be pretty simple. Once you log on, again, pre-populated, just review the stuff on there, submit, and that's as simple as it is. And once it's submitted, it closes. If you due a refund, SARS will pay you within the next few days thereafter. If you owe SARS, then make sure that, whatever it is that you owe SARS, just pay them within the next few days. You don't want to have interest incurred on those amounts unnecessarily as well.
Thanks, Darren. And then I think just to add to that, so tax practitioners can do that return for you. So if you are expecting a return of, say, 20,000 Rand and you're happy to pay 500 Rand to somebody to do the return for you, you can do that. It is an option. So you can pay a tax practitioner, but you will then have to pay them before you get the SARS refund. So you can't pay them after the SARS refund. So just factor that into your planning if that's something that you don't feel completely comfortable to do. Okay, I have two questions and then we are logging off. Motsai, I'm going to summarize this question. It's rather lengthy. 45 years old with no pension savings. I have a few investments and I'm in the process of starting my own business. I have one afterlife support against one government institution, so my old age retirement accommodation will be paid for. My question is, how do I navigate the next 15 years? As sometimes I run out of money.
Okay, that's a so it depends what it'll have to be. If you're running out of money, then obviously you're spending outside of your means. So just maybe putting a simple budget together. You've got income, obviously, that I can see. Your expenses are running at some months higher than your income. I don't know if those are all needed expenses. If there are some wants in there, cut out the wants, cut out where you can, and then from there, if you keep cutting all the excess or all the leakage, you'll end up having a little bit of money every month. And from that little bit of money, put it into a savings account, into some sort of, because looking at the next 15 years, it's not a long period of time. So I would say put it into a tax-free investment, or even if it's like 100 Rand a month or whatever it is, it's something that's going towards your future. As you said, your old age retirement accommodation will be paid for. So now you need running costs, you need groceries, you need survival costs basically, other than your accommodation in your old age. So it'll be just putting a little bit away. The more you can, the better, obviously. But I think start with just putting your stuff down on a page, even if it's just writing it out. Write out your income. These are the things you know that you spend on monthly. And if you see that your expenses are higher than your income, then there's your first problem. Second problem, you have a lot of, if it's not all needs on your expenses, then cut out the wants and see from there if you can make it work for you going forward.
Thank you, Darren. Last question, Tumelo. We are here for you. So Tumelo wants to know, if I pay UIF and I never claim it, what happens when I go and work at the next employer? Do I get all the money back eventually?
So yeah, UIF contributions are not linked to you specifically. They're just paid by your employer. You contribute 1% of your salary, your employer contributes 1% of your salary, and then it gets given to the UIF, the government institution, the UIF institution within the government, and they house the money. It doesn't attach to your contribution to Melo. So when you move to another company, that's just you moving, and then you contribute similarly at the other company. The only time you're able to claim is in any sort of position where you're not earning your full salary. So if you're, as I said in my example on maternity leave, some companies don't pay full salary when you're on maternity leave. They might pay you a percentage. Some companies treat it as unpaid leave. So in those instances where you can prove that you should have earned 10,000 Rand that month, but your company, because you were on maternity leave, you only earned 5,000, so UIF will supplement the other 5,000 for you. But in saying that, you have to have all the necessary documentations to submit. You have to be able to prove it through your company as well, that you were on maternity leave. Or you could be like in disability leave, or something that stops you from performing the job that you're performing in order to get paid what you should be getting paid based on your contract. That's sort of what the UIF is there for. It doesn't link to you specifically at one company, and then if it's not claimed there, it's lost. It's all just contributions made by a company, and it's not made on your behalf in your name specifically. It's just made towards or by the company towards that UIF fund. So I hope that helps. Not everyone claims UIF as well. It could be something you just contribute towards and never claim towards, or never claim from. Like as a male, you'll never have maternity leave, and if you're never disabled and you're always just working, you'll always just contribute 1% of your salary towards the UIF and never really be able to claim from them. So it is just it is a deduction. It's a mandatory deduction that's now worked into our salaries as well. So yeah, it's not for everyone, but it's just a fund that builds for people that are able to claim from.
And then just to add to that, Darren, you can't resign from your job to take a 3-month break and go and claim UIF.
Yeah. So it's only claimable if you're supposed to be earning something, as in you are employed by the company, and you can't because you're disabled for a certain period, or you're on maternity leave for a certain period. And during that period, they will cover your, maybe not your full salary, it is capped as well. So if you're earning 50,000 Rand a month and you're not earning anything now, it is capped at like 17,000 or something. So you'll never end up probably earning your full salary from the UIF during that period.
And if you are retrenched, you can go and claim UIF while you find another job, but it's not indefinite. You can't just be unemployed for 5 years claiming UIF. That will never happen. We don't have that type of benefit system in South Africa. All right, thank you so much, Darren. I think this was a fantastic presentation. As you can see in the comments, very well received. And I truly hope everybody is walking away tonight hoping to pick up pen and paper and ask yourself those hard questions of where on earth does my money go? Because no matter how old you are, no matter how much money you have, you will always be scratching your head going, where the hell does my money go?
Yeah.
So it's very important. It doesn't ever change. It's very important that you cultivate that discipline and start teaching the next generation that there's a certain lifestyle that is accessible, and it's okay to say, I can't afford that. Even if you are earning a good salary, it's okay. Everybody has things that they can't afford. Even billionaires they can't go to the moon. So there's things that everyone can't afford. Everybody lives with that constraint. It's how you position that constraint in your mind and what you do every day to live with that. So thank you, everybody. It's been a bit of a lengthy session, but I'm sure everyone has found value. Thank you very much, Darren. We really appreciate your time and your preparation. And thinking of Jane, the highly earning, highly successful, getting a nice tax rebate, living in the dream.
I hope that's something that helped you guys, just having someone to attach all the examples to and then applying it to your own life. But as has been mentioned as well, the more you earn, the more you spend, and that's the reality of things. And if you're not planning wisely, you will end up spending the bit more that you earn. So it's always good to have a plan. And
yes, absolutely.
Yeah, so all the best to everyone. I hope that today's session helps. And if you don't take anything away, just maybe take 2 or 3 pieces away from everything that you heard today. And I'm sure it will hold you in good stead and put you in a better financial position going forward, and hopefully being able to plan for your futures a bit better.
Fantastic. Thank you so much, Darren. I'm going to be closing the session now, so you're welcome to exit. If you don't voluntarily exit, I will come at you like SARS and I will force you out. But thank you very much for all your time. And the session has been recorded. We will edit it and load it up to our YouTube channel in the next few days. So if you want to share it with any of your family members, please do so. Share it on your social media pages. We'll share it on our Facebook page as well. I think this type of information is critical for everybody. Thank you, everyone. Have a lovely evening further, and don't make me kick you out. Thanks, everybody.
Thanks, guys.
Thanks, Darren. We'll chat tomorrow.
Cheers. Yes.